Joining us now is Apollo Global Management Chief Economist Torsten Slok. Torsten, it's great to have you back on the show. What's amazing is how much Fed speak we got today. And in the midst of it all, you put out a note this week that's been getting a lot of circulation where you're basically saying, guess what? It's going to be higher for longer. Looking at the inflation data, don't expect the Fed to cut rates at all this year. Why is that the thesis?
It's exactly because what you and John just spoke about, namely we're at all-time highs in the stock market. Credit spreads on IG are very tight. Credit spreads on high yield are very tight. Loan spreads are very tight. IG issuance in January was the best January on record. You also saw high yield issuance was strong. You've seen loan issuance being strong. And you're also beginning to see IPO activity begin to pick up and M&A activity begin to pick up. So it is not surprising that this easing in financial conditions created a very strong employment report in January of more than 300,000 jobs created. And now also, likewise, we're seeing also a beginning of an uptick in inflation in January. So all that we are pointing out is that this tailwind from easing financial conditions that all began with the Fed meeting on December the 13th when they pivoted from hawkish to dovish. All this is going to lift growth, lift economic activity, and the wealth effect from stocks going up is also going to lift consumer spending. So that's why we expect now that the Fed will probably stay on hold until the end of this year because the tailwind to growth over the next several quarters continues to be so strong.
Okay, but what about the counter argument that January in particular, the data, there's a lot of noise. You had a lot of bad weather. It distorted things. Today, as I mentioned, we had a lot of Fed speak. We had Goolsbee, we had Bostic, we had Waller, we had Logan, we had Daly, we had Kugler, and we also had Barkin, who, when our own Steve Leisman asked him on CNBC today if he still believes there will be rate cuts this year, had this to say.
I'm still hopeful inflation is going to come down, and inflation normalizes, then it makes the case for why you'd want to start normalizing rates.
So what is normalizing rates actually? I guess what is it going to take for you to feel like inflation's coming down meaningfully enough that you see that normalizing rate process actually start to happen? Because we also know officials have said we don't need to hit 2% for that to start.
Well, you're right, Morgan, but in the 10 charts that I sent you and the reasons why we are now saying the Fed will not cut this year, there were a number of indicators, including indicators from the small business community that are pointing to small businesses beginning to raise prices over the next 3 months, beginning to raise wages over the next 3 months. You're seeing ISM prices paid on the manufacturing side beginning to go up. ISM services prices paid also going up. These are all very important leading indicators, and combined with the underlying trend in inflation also picking up. And as you highlighted, there's been a lot of discussion about, oh, this is just because of some statistical issues in the data. But you're beginning to wonder, is it just statistical noise that inflation is picking up? Well, what about, is it also just statistical noise that non-farm payrolls was more than 300,000 in January? It cannot just all be statistical noise. It's beginning to paint the picture that there is just a lot stronger tailwind to growth coming along from, in particular, the easing of financial conditions that we have seen since the Fed began to pivot on the December 3rd FOMC meeting.